FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today's October 4th, 2017. Well, what is going on in D.C.? Will we have tax reform? Is the Fed really going to pare its balance sheet and continue with rate hikes even after the 2 major hurricanes that hit Houston and Puerto Rico? Minor one that hit Florida. Didn't do that much damage. Well, let's figure this out together. David Scranton is back with us, author of Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. And you find David over at soundincomestrategies.com. And by the way, email us, kl@kerrylutz.com. Questions, comments, feedback. David, welcome back.
Well, thanks for having me. It's good to be back.
And likewise. And so, your current thesis, could the Fed shake up Wall Street even more than the Congress? Well, you know what they say about the Congress, David, or at least Will Rogers said it probably 100 years ago. Every time they make a law, it's a joke. And every time they make a joke, it's a law. So for the Fed to do more harm than that, well, Janet Yellen is the most important woman in the world, isn't she?
In many ways, that is correct. And, I think what people don't have enough appreciation for is, and probably because it has been publicized this way, is that what happened during the financial crisis with all this QE and this quantitative easing, this printing of money to buy back bonds, to artificially drive down long-term interest rates, was completely unprecedented. The effects, they weren't sure what the effects were going to be. In fact, I think they were disappointed to some degree in the effects of it. But now we're unwinding it. And it becomes really the world's greatest financial experiment ever. And, if you go into a science lab and you mix 2 chemicals together as an experiment, you put them in an Erlenmeyer flask or beaker, sometimes all goes well and sometimes you have an explosion. And people just need to realize there's a possibility that this laboratory experiment goes awry and the unraveling of it ends up creating an explosion. Now, don't get me wrong. Jenny Yellen's a smart lady. I think she's going to be very, very careful with this. And I think if it seems like there's anything wrong, she's going to going wrong with the markets or anything, she's going to discontinue it. She's been listening to the markets even more than she's supposed to as the Fed chair. Not that that's a bad thing, but that's what's been happening. But still, it's a big laboratory experiment. And so investors just need to be careful.
Well, let's carry your laboratory experiment analogy a little further and say that you, me, and 330 million other people other than the top 1% are all lab rats. And we're kind of at the mercy of this lab experiment. And unless you get out of that cage and take steps accordingly, just in case the great experimenter, the great fiscal, the great monetary experimenteress, if you will, screws things up, you don't want to be there when it all blows up, because you know what happens to lab rats, David, right?
What happens to lab rats, Kerry?
Well, they don't have a real long life expectancy. Let's just put it that way.
Well, and that's so true. And first of all, the bottom of the market after the financial crisis was literally 8.5 years ago.
Mm-hmm.
So we had a huge recovery since then. And a friend of mine who's a well-known financial advisor out of California, he says that right now the market is like a balloon that's floating around looking for a needle to land on. And his point is, what's that needle going to be? Is it going to be North Korea? Is it going to be Trump not having success with his tax plan through Congress? Is it going to be the unraveling of QE? The answer is we really don't know. But the reason I think stock market investors, which include mutual fund investors, as you well know, the reason they need to be careful about this is simple. Part of what caused the stock market to go up over the last 8.5 years is the fact that people got pushed up the risk curve. And what that means is that, because long-term interest rates were artificially driven down, people kind of threw up their hands and said, well, I can't make a lot of money in interest-bearing alternatives, so I might as well throw my money in the stock market and cross my fingers and hope for the best. Well, now if this unraveling serves to push long-term interest rates back up again, a lot of those people might slide back down the risk curve. They might say, oh, well, now I do want to lower my risk. And it could cause that market to come tumbling back down again. So people just need to be careful of that if that's the thing that caused the market to go up, and one of the major components that caused the market to go up, then the unraveling of that could be the thing that causes the market to come back down again. And unfortunately, if you listen to the talking heads on television, they're not going to tell you that because, they have an axe to grind. Their axe is to be the stock market cheerleaders, as I talked about in my first book, Stop Financial Insanity. Their goal is to always talk positively and optimistically about the stock market because that's the business they're in. It's really that simple.
Well, I always say their slogan is ABB, always be buying. No matter what's going on in the market. If it's going down thousands of points, it's a buying opportunity. If it's going up and it's near its highs, well, hey, it's going to go even higher because it's near its 52-week high, and it always goes higher. And even if the market goes down, it always gains back its losses, which has been true in the past, but over what period of time? And one other point, David, when we go back to the financial crisis of 08-09, and we look at the real economy rather than looking at Wall Street and real estate, which real estate is the real economy, but still, when we look at the workforce participation rate, we look at food stamp recipients, which are just starting to go down now under Trump. All of these things, it doesn't really look like the real economy ever had much of a recovery, does it?
I mean, it had a great recovery since the financial crisis. I mean, that was, it wasn't as bad as the Great Depression, but it was, I feel as though it could have become another Great Depression had the government not stepped in to do something. But, they invested probably 4 or 5 times as much in quantitative easing as they should have. They should have stopped a long time ago. So yes, there's been a recovery, but it's been a lot slower than anybody hoped for, especially the Federal Reserve. All these statistics about unemployment rates being down. The unemployment rate's down, but when you look, when you look at how many people are underemployed, that are discouraged workers that have come out of the statistic, it doesn't, the old saying that figures don't lie, but liars figure, that kind of thing. Well, the numbers can work to prove whatever point they want. And they want to sell optimism like the Wall Street cheerleaders. They want us to feel good about the economy. But you ask a lot of people, especially people that aren't on the coasts. The coasts did better as a general rule, but you get some of the people that are inland, some of those red states back in November in the election, and a lot of those people are not feeling good about the way things are going financially. So, your point is very, very well taken.
Hey, and there's 3 types of lies, damn lies, and statistics, right? As the man once said. So
I love that. It's great. But that's why it was a great time, for your Trump fans listening, it was a great time to get somebody like President Trump elected, because the reality of it is the country was ready. And that's why they have all those red states in the middle of the country, because they really felt the brunt. It seems like on the coasts, things recovered a little bit better. In fact, I was just talking to someone last night who's a big real estate investor who's buying real estate here in Florida. And he says, I can't buy anything anymore. It's too high. It's like 2007 all over again. So I'm just sitting on cash. Yeah. And again, that's the coasts. But as you know, you go to real estate in the middle of the country, and a lot of those values haven't come back yet.
Yeah, exactly. The coasts are at or near all-time highs. And so Trump, this, David, you'll agree that this bull market is very long of tooth, but Trump has proposed a pretty substantial tax rejiggering, if you will. Certainly the lowering of the corporate rate to 20%, lower the pass-through rate on LLCs and S-corps, partnerships, that type of thing, 25%, way down from where it is now. I mean, it's at 35%, the corporate tax rate. We're not even factoring in state taxes. Is it going to go through, and what will be the ramifications if it doesn't, David?
Well, I think you asked the perfect question. Not what are the ramifications if it does go through. It's what are the ramifications if it doesn't. Because right now, I believe that that's priced in the market. The reason the market's up almost 20% since the election is simple. Wall Street is looking at Trump's tax plan, or at least what he talked about during the election, and saying, ever since then, has been saying, you know what? If we can reduce the taxes that corporations have to pay, then we can increase the amount of money that they keep, their net earnings. If we can increase their net earnings, well, then heck, prices of stocks can go up, and we haven't even changed our price-to-earnings ratio because earnings went up with a stroke of a pen in Congress, and therefore the price can go up. And I believe that's a major part of the reason why the prices have come up nearly 20% since the election. But the question is, what happens now if it doesn't go through, meaning his tax plan? And the answer is that we give back that 20%. And because, as you know, the way momentum works with the markets, it's not likely to stop at a 20% give back. It's likely to continue to slide a bit further because, again, when success of something like that is priced into the market and then you don't get that success, then you have more to lose than you have to gain if it indeed were successful. So, I just hope that, he's realizing that, with the art of the deal and everything, that what it takes to craft a private deal is much more different from what it takes to craft a deal in Congress. And hopefully some of his lack of successes so far with that have taught him enough so that now he can go back and literally get some success pushing this through. He needs bipartisan support. And if he does, then the market could stay at high values for a while. But that's certainly an if.
Yeah. Well, the one thing I will say is that Trump has not yet bought a dog. And they say in Washington, if you want a friend, buy a dog. So we'll know he's giving up when he gets some canine company in the White House.
Well, you think he's smart enough to do it. He just needs to figure out how to make that happen. And what I'm referring to specifically is that corporate tax cut. That's a big deal. And I don't think 25% is going to do it. I think if we cut rates to 25%, then all of a sudden we don't attract. I don't think it's going to be enough to stop this trend of corporations leaving the United States. We need to get 20%. 20%, I think, will do it. 25% will not. As far as the flow through with S corps and everything, those are smaller businesses. If that doesn't go through, it doesn't go through. But the corporate tax rate is the biggest thing that has to go through to keep the stock market where it is today, in my opinion.
Well, for small businesses, that little cut of 10%. Is a lot of money, and especially if you're able to escape the 39.6% tax rate with a 25% tax rate. Look, it's going to have unintended consequences. A lot of big companies will convert. You mark my words. We should talk about what the benefits to businesses are and individuals of these tax cuts. It looks to me like the individual side is really like it's nothing. It's very insubstantial in the scheme of things. They give with the one hand, they take away with the other. It looks to me like the real major part of this is for businesses. And also it will force a discipline upon the high tax blue states that they don't really want.
Well, and that makes sense. And yes, I'd like to see even for subchapter S corporations and LLCs be able to pay tax at a lower rate. That's all good. The problem, when everybody says trickle-down economics doesn't work, a big part of the reason it doesn't work is because it's not given enough time. To me, 8 years, 2 administrations in the presidency and Congress and everything is really, that's just enough time to get it started. But the beauty about our country is that's based upon capitalism, and capitalists want to make more money. And if there's a government that enables them to make more money and they feel safe, they're going to invest, whether they're investing in more equipment or they're investing in more employees, et cetera, et cetera. So it can work, but it's got to be given the right chance. But the reason I'm making such a big deal about the corporate rate itself is because, when companies leave the United States and they decide to be domiciled somewhere else, jobs leave also. And that is probably the worst thing for a country. And that's why I say if there's one thing that has to get through in the tax code, it has to be that corporate tax cut. And everybody thinks, some people think it's for the Wall Street fat cats, but that's not what it's about. It's not for the executives. It's really about keeping companies here and keeping jobs here. That's going to help the middle class more than any possible tax cut they could give.
Yeah, agreed. There's a lot more at play here than just how much you pay each paycheck in taxes, a lot more going, and the competitiveness of the country is really at stake. Cutting the rate really almost by 50%. That's meaningful money here. Keeps companies here and will also get companies to invest who otherwise may not have invested.
Yeah. Absolutely. And, that's why when I made the comment at the beginning, I said, the market is potentially a balloon that's floating around looking for a needle to land on. People need to take what they hear on TV with a grain of salt and on radio with a grain of salt, because they have to determine, does this make sense? Does this feel right? And that's why I wrote Return on Principle, because I wanted people not just to look at the algorithms of how to invest, but I wanted to see give people a tool to determine whether or not they have the right internal instincts, the right gut instincts to make good financial decisions. And for those that decide they don't, for them to then determine if a financial advisor with whom they're working, with whom they're interviewing, has the right gut instincts to really size all this up and just say, something doesn't feel quite right now. I mean, let's face it, every doctor went to medical school, but not everyone is like the TV character Dr. House, who has the right medical instincts when other doctors, of course he's a fictional character, as you know, but, to have the right instincts when other doctors are following the textbook and fail. And the same is true about financial advisors. So again, that's the reason I wrote that book, especially for times like this, when people need to look at everything and say, something just doesn't feel quite right, and to be able to act on that feeling.
Absolutely. Couldn't agree with you more. Things are definitely different now than they've been in the past. Will they go back to normal? We'll see about that. David, want to find out more about you, connect with you, get your book, best place to go?
We have a website for the book. It's called returnonprinciple.com, and principle is spelled ending in P-L-E. Every once in a while, I get an email from someone who says, well, if you can't even spell the title of your book right, why would I want to buy your book? And, of course, the answer is we purposely spelled it ending in P-L-E. So it's returnonprinciple.com.
All right, returnonprinciple.com. As always, we'll have a link to it on our website in the show notes to this interview, financialsurvivalnetwork.com. While you're there, sign up for our newsletter, our Twitter feeds at Kerry Lutz, and the Facebook page is Financial Survival Network. David, we'll talk to you again soon. Thanks so much.
Thanks for having me, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.